So seasonality speaks to the condition and the trend of the stock market, or really any financial market, in any given point of the year. Knowing what months are strong, knowing what months are usually up and what months are usually down, knowing what months are weak can be extremely helpful. Let's talk about some seasonal patterns so we can start making money from it. Hey, I'm Chris Rowe. I'm the founder and CEO of True Market Insiders. It's an investment research firm, investment education firm, data algorithms, a lot of cool stuff. I've been trading stocks and a market analyst since 1995. It's pretty much the only thing that I ever do besides hang out with my family. So it's a little bit sad, but also can benefit you greatly. Today, I'm going to show you one of the most powerful concepts in technical analysis. And it's really cool because investors invest sometimes on schedules, like major funds like 401ks or pension funds, stuff like that. They invest their money on schedules. You know, it could be every 6 months, every quarter, every month, or even once a year. And all of those fall at the beginning of every year, right? At the beginning of the year, you've got the monthlies, you've got the quarterlies, you've got the semi-annualies and the annualies. In any case, phenomenons like that cause the market to behave a certain way during certain times of the year. There's a lot of other reasons for it, but just know that seasonality exists. So seasonality speaks to the condition and the trend of the stock market, or really any financial market, in any given point of the year. Knowing what months are strong, knowing what months are usually up and what months are usually down, knowing what months are weak can be extremely helpful. By the way, let me pause here for a second. If you like what I'm telling you right now, just pause this for just a second and subscribe to this channel before you forget. And if you like it, and leave a comment. I might just answer the question or share it. But I'm trying to get this word out to everybody because investing is not really that difficult and they don't teach it in school and it drives me crazy and I just want to help people level the playing field. It's not that hard. Don't feel intimidated. You could do it. All right, back to seasonality. Don't forget to subscribe to the YouTube channel. So we're going to talk about seasonality, but first I want to give you a couple of caveats. You should never trade based solely on seasonal patterns because a lot of the studies that basically tell us these seasonal patterns, there's wide variation in the outcome. The seasonal patterns might be a result of a 100-year study. So just because April's usually a strong month doesn't mean it can't be a horrible month. You should always confirm your market stance and your trade idea with technical indicators like the RSI and the M.A.C.D, which are momentum indicators, or the New York Stock Exchange BPI, which is an internal indicator. If you want to learn more about that, go to majorbottom.com or truemarketinsiders.com/BPI. It's the granddaddy of all technical indicators, the New York Stock Exchange Bullish Percent Index. But this is a discussion about seasonality, but it's important we talk about those indicators just because I want you to confirm what your suspicions are with these indicators when it comes to the timing of your trades. Before I go any further, I just want to pay homage and respect to the founders of the Stock Traders Almanac. So Yale Hirsch, I think, founded it in 1967, and Jeffrey Hirsch continues to carry the torch. It's a father and son. And they've done lots of extensive research on seasonal patterns and cyclical patterns. So you have to give a lot of respect. A lot of people quote the Stock Traders Almanac. It's a very inexpensive book. You should probably buy it. You might want to sign up with their, on their website. Just Google. And he also has a free one, a Tumblr site. So just Google Tumblr and Hirsch, Jeffrey Hirsch. I don't have any business relationship or anything like that. I don't profit from this. I'm just telling you because it's just a good source of information. Now, in the Almanac, you're going to find information and insights about every kind of seasonal pattern there is. And on the website, you're actually going to be able to manipulate the data and do studies of your own. So anyway, I buy the Almanac every single year. You probably know a lot of people that also do it. And it's an amazing resource. So that Tumblr website is called Almanac Trader. It's an amazing resource, and you can order it from that Tumblr website. Now remember, I said that you should always confirm your market stance and your trade idea with technical indicators like the RSI and the M.A.C.D. Well, Stock Traders Almanac has a pretty well-known trick that they use where they combine seasonality and the M.A.C.D. So they know that usually in May, markets start to get weak. So in May, they wait for the first M.A.C.D sell signal that they see. Because what if the market continues higher throughout June and July and August? This will keep you from selling too early. So they wait after May. If there's a M.A.C.D sell signal, they'll sell. And after October, if there's a M.A.C.D buy signal, they'll buy. So that this way, if the stock market continues going lower throughout October, November, December, you're not just blindly buying with a seasonal trend. So you can use the M.A.C.D or you could use some other indicator that you prefer, but just make sure to combine seasonality with indicators. When the COVID market crashed back in March of 2020, it was a much more important development than any seasonal pattern, right? So that's a good example where seasonality just goes out the window. All right, let's talk about some seasonal patterns so we can start making money from it. We'll begin with one almost everybody's familiar with. It's the seasonal pattern known officially as the best 6-month cycle. Everybody remembers it by the famous rhyme, sell in May, go away. Refers to the historical tendency for the stock market to be at its weakest point in the months between May through October, and to be at its strongest points in the other months, so from November through April. Usually the market bottoms out in October. It's a very famous bottoming month. One reason this seasonal pattern is so well known is that it works so well. Since 1945, the S&P 500 has gained an average of about 2% from May through October. So in the weak time of the year, it only gained about 2%. That compares with about a 6% average gain from November through April. And speaking of April, it's typically the strongest month of the year. According to the Almanac, counting back from 2021, the Dow Jones was up 16 Aprils in a row. It had an average gain of 2.9% just in that month alone. That's more than the entire week season. Now keep in mind that with April being a strong month, that's a good time for people to start unloading their bullish position. That's the time when everybody starts to look around and say, all right, what are we doing? We're about to enter into the weak season. So the S&P 500 was up 15 of the last 16 Aprils. I told you the Dow was up 16 for 16. But the S&P had an average gain of 3.1%, and the Dow had an average gain of 2.9%. Here's another seasonal pattern that you might have heard of. It's the Santa Claus rally. Everybody knows this one. The Santa Claus rally refers to the tendency of the S&P 500 to rally in the last 5 trading days of December and the first 2 trading days of January. So since 1950, the stock market's gained, on average, 1.3% over that small seasonal period. A lot of people just say Santa Claus rally, just in general. They usually don't know that it's from that one day to that other day. Also, if the rally fails to arrive, it could spell tough times ahead for the market. Another seasonal pattern is the January effect. So this pattern basically says that as January goes, so goes the rest of the year. The Stock Traders Almanac invented something called the January barometer based on this seasonal pattern. So according to the Almanac, the performance of the market in January has foretold the course of the market for the rest of the year 73.2% of the time. But what's so important about January? Well, what really moves stock prices is buying and selling by giant institutions. There are certain times of the year when, like clockwork, those big funds make investments into the market. Some invest at the beginning of each quarter. Others invest every 6 months. Some invest every 1 month. Some only invest once a year, but without fail, they all invest at the beginning of January. Big institutional contributors to the market, meaning those that are putting money into the market and they're big institutional investors, are the biggest reason that January historically has been a robust month. And knowing that historically it's a robust month, and knowing that all those different types of funds that invest on schedule all invest in January, it's a bad sign if January is a weak month, considering all that money is flowing into the market. Imagine if that money wasn't flowing into the market. And it means that given all that scheduled buying, if we see a bad January, it probably means a bad rest of the year. So what did January have to say about 2022? Well, this year, the market was down huge, 5.26%. And it was even lower than that in the middle of the month. You know what's happened since then? Market has fallen even lower. Even April, which is usually strong, was weak in 2022. The S&P was down 8.79%. The Dow was down 4.9%. And the NASDAQ lost an incredible 13.26%. So I want to pause here for a second and remind you, these are seasonal patterns, but then there's bigger patterns that are cyclical patterns. Like there's the 4-year presidential election cycle, which has the presidential election year, the post-election year, the midterm election year, and the pre-election year. And then it goes back to the election year. So out of the 4 years of the presidential election cycle, the midterm year is by far the worst year, and 2022 is a midterm year. So it's already on schedule because of that cycle to be a bad year. But when you have a Democrat in office, when it's his second year, and these are just the statistics, here's what it usually looks like. It's the red line on your screen. So that's what is to be expected in a midterm election year. But look at what's happened since the beginning of the year through January. You could see how terrible the market performed. Compare that to the red line. Red line is how we're supposed to perform. The gray line is how we did perform. So what does this say when you combine that cycle, you combine the midterm election year, and you know the increased volatility is about to come? It's not going to be a good year. Not for bulls anyway. If you're betting on downside moves like me and my followers, then you're probably going to make a lot of money. When I asked Mr. Hirsch, remember the son at the Stock Traders Almanac, When I asked him about the midterm election and what the effect is, he said, quote, that bottom-picking paradise is in the midterm year. He called it a bottom-picking paradise. I like it. Had to repeat it. The pre-election year, 2023, next year, is hands down the strongest year of the 4-year presidential election cycle. Since 1914, the Dow gained 47.4% on average from the midterm election year to the following year, the pre-election year. And here's something else that you'll find exciting. The effect that you just heard about is actually stronger and actually more pronounced when there's a Democrat in the White House like we have right now. You can think of that as sort of a seasonal pattern inside of a cyclical pattern. So cycles usually are more than a year, and seasonality usually speaks to the time of the year that you're in. There are many more seasonal patterns, and the ones that we just looked at happen to be the most popular. If you found this survey of seasonal patterns valuable, don't forget to subscribe, hit the like button. I want to teach you more about the financial markets. Thank you for joining me today. Make sure you subscribe. I'm Chris Rowe, True Market Insiders. See you on the next one.